Hey guys, welcome to STOXMASTER. In the previous video, we learned about the fundamental analysis. Now, you are going to dive that very important concept in the stock market, the technical analysis. Whether you're an investor, swing trader, positional trader, scalper, options trading, futures, whatever the trading may be, but the technical analysis is the very a key factor for us to confirm the trade. So, such an interesting topic. Now, we are going to learn very clearly in this video. Let's go. Mastering technical analysis is essential for any trader looking to navigate the complexities of the financial markets. By understanding the price charts, the chart patterns, indicators, the support and resistance, all these things. By learning all these things, you can improve your trading strategy and increase your chances of success. This is the second video in the technical analysis. In the previous video, I explained about the price charts. So many types of price charts are there: line chart, candlestick chart, bar chart, Heikenhaus chart, like so many things I explained in the previous video. If you didn't watch the video, please watch the video and then come here, then you will get a clear idea. Right? Now I will continue with the technical indicators. Yes, technical indicators, so many are there. Some of the indicators we will discuss now. The first one is moving averages. Second one, relative strength index, RSI. The next, moving average, convergence, divergence, MACD. Now, Bollinger Bands. Next, stochastic oscillator. Then afterwards, volume indicators and Ichimoku. These are the very prominent indicators used by the traders. Moving averages are fundamental tool in technical analysis used to smooth out price data and identify trends over a specified period. They are calculated by taking the average price of an asset over a certain number of periods, with the resulting value plotted on chart. Moving averages help traders filter out short-term price fluctuations and focus on the overall direction of the trend. There are three types of moving averages. They are SMA, simple moving average; EMA, exponential moving average; WMA, weighted moving average. A simple moving average is calculated by summing up the closing prices of a security over a specified number of periods and then dividing by the number of periods. For example, a 50-day simple moving average is calculated by adding up to the closing prices of last 50 days and dividing by 50. SMA simply P1 plus P2 plus P3 and so on up to Pn whole by n, whereas P1, P2, P3 are the closing prices of the stock over a period of time, simply n. So n is the number of periods, simply number of days, right? That is about simple moving average. So here we consider we have to give first priority to the closing prices. So SMA is equal to P1 plus P2 plus and so on, Pn by n number of days. So by using this principle, we can get a simple moving average indicator. So by the simple moving average, we can identify the trend. See, some more are there in the next exponential moving average. Exponential moving average. It gives more weight to recent prices, making it more responsive to current price movements compared to the SMA. So simply EMA is better than SMA. It is calculated using a formula that applies more significance to the most recent data points while still considering historical data. So EMA is equal to close minus EMA previous into 2 by n plus 1 plus EMA previous whole by n. Whereas close is the most recent closing price, EMA previous is the previous EMA value, n is the number of periods, number of days. By using this formula, we can calculate the exponential moving average. So generally, the moving averages are often used to identify the trends and potential reversal points in the market. When the price is above the moving average, it is often considered as a bullish signal, indicating that it is uptrend. Conversely, when the price is below the moving average, it may suggest a bearish trend. Additionally, some more are there next in the WMA. Weighted moving average is another type of moving average that assigns different weights to each data point in the calculation. Unlike the SMA simple moving average, which assigns equal weight to each period. But the weighted moving average gives more importance to the recent data points. The formula for calculating the weighted moving average is WMA is equal to W1 into P1 plus W2 into P2 plus and so on WN into Pn whole by W1 plus W2 plus W3 and so on Wn. Whereas P1, P2, P3 and so on Pn are the prices of the asset of each period. Each period, here the period means the time. So either 1 minute, 5 minutes, 1 day, 5 days, 10 days, 1 month, whatever. Simply the period means time here. We have to consider. And W1, W2, W3 and so on Wn are the weights assigned to each period. So the sum of the weights should add up to 1. Simply, the most recent data points are given higher weights, while older data points are assigned lower weights. Recent data got higher weight. Older data got lower weights. The weights are typically assigned linearly or exponentially, depending on the trader's preference or the specific trading strategy being employed. So weighted moving averages are more responsive responsive to recent price changes compared to the simple moving averages, making them useful for traders who want to place more emphasis on recent market movements. However, because they assign more weight to recent data, they may also be more prone to whipsaws and false signals in volatile market conditions. As with other technical indicators, it's essential to combine WMA with other analytical tools. And the most important thing is risk management. So the risk management strategies, we will get the effective trading decisions. So already in the simple moving average and exponential moving average and the weighted moving average, so all the moving averages will give us a clear signal that uptrend, bullish signal, downtrend, bearish signal. Simply if the price, if the moving average line is, if the price, the moving average line and the price, if we observe the price is above the moving average line, then that is uptrend, that is bullish signal. Below the moving average line, that is bearish signal. Simply SMA, EMA, WMA. In these three, we consider WMA is most appropriate indicator than compared with SMA. Yeah, up to now, you learned about the SMA, EMA, WMA. Now, two more are there. So, Goldencross and Death Cross. The 50-day moving average, simple moving average, is crossing above the 200-day simple moving average. Then, such a crossing is called as Golden Cross. Here, you can see the chart. This is 200-day moving average. This is 50-day moving average. So the 50-day moving average is crossing the 200-day moving average. So such a cross is called as Golden Cross. Here the buyers are here. The buyers get a good opportunity to buy the stock. Right. The next one is Death Cross. The 50-day SMA is crossing below the 200-day SMA, then such a movement, such a crossing is called as Death Cross. So now you can see in the chart here, that is the 200-day moving average, this is the 50-day moving average in red color, this is in blue color, right? So it is crossing below the level, 200-day moving average level. So such a movement is, such a crossing is called as Death Cross. So here this is Death Cross, this is Golden Cross. In the Death Cross, the sellers are ready to sell the stock. So here, this is the Golden Cross. Cross is an opportunity for the buyers. Death Cross is an opportunity for sellers. So that's for today. I hope that this video is helpful to you. So then please like, share and subscribe my channel. Thank you. Happy trading.